Hey everyone, how's it going? So in my last video, I showed you how you could plot an option contract on a chart, and I had a few questions. One of those was how you could view multiple contracts or possibly a spread or a more complex trade. And what we're looking at right now is an iron condor in the SPY. And then another question that I had was, what could this be used for? And one thing I think really best used for probably just single contracts is actually looking at the volume and the open interest over time. So, just in this spread alone here, the volume went from, or I'm sorry, the open interest went from roughly 2,000 to, probably over 4,000 right here, just in this day. But it's probably going to be more helpful when you're looking at a single contract and possibly trying to track, maybe unusual options activity, that type of thing. But I guess maybe that could be one reason to use this. Back to how to add multiple contracts or maybe even more complex trades. To do that, all you need to do is actually just place a negative symbol inside of the contract that you're selling. And I have positive symbols placed in some of these, mainly just to help me denote, what is long and what is short here. I don't believe you actually have to put the positive symbol in there. I'm just doing it to help me differentiate here. So basically what we're looking at here is we're short the 450 put and short the 510 call. This is the SPY. And then we're long the 440 and the 520. So it's basically a 10-point wide iron condor. And I find it's actually easiest to add these trades if you actually open up a WordPad or a Notepad and you paste them in. Just because it's just the screen that you have up here to add in is a little bit small. And I also thought I would maybe kind of just give a quick primer as to what these numbers mean right here, if it's not completely obvious. But basically at first you just have the ticker symbol, which is SPY. Next you have the year, which is 2024. So we just use 24. Next you have the month, 03, March. And then lastly here we have the date of the expiration, the 28th. And I'm using the 28th in all these because that is a quarterly expiration. So this expiration has been around for almost a year. So we can actually look back a very long time at these contracts. Versus if you're going to look at something that's a weekly expiration that may have only been around for maybe, 30 to 60 days, something like that. But anyway, next we have in here, you have either P or C for put or call. And then lastly, you just have your strike. Anyway, we're looking at the iron condor right here. I'll go back to it. So, we can see since we're actually short the 510 call and the SPY is, up around 510, 513. I'm not sure the exact price of the SPY right now. It looks like this is a comparison for SPX. Let me actually change that. And one thing to actually make this a little bit easier for you is go to your studies, add or edit studies, and make sure you add a comparison line. I think this makes it a little bit more helpful. That way you can compare the price of the underlying that you're looking at. So I'm going to choose SPY. And then another thing I do is put the open interest on a lower time frame right here. Otherwise it'll be up here on the chart, which isn't too bad, but it's a little bit easier to read when it's on the bottom. So I do recommend that you do that. And, once you do that, you can actually plot the price of the SPY over time, and then you can compare how that has interacted with the price of this spread. So, once again, the SPY has been climbing right here. So, I guess it's at, 512, somewhere in that range. And since we're short the 510 call in this iron condor, our iron condor is starting to lose money right here. And it's a 10-point wide spread. So, currently it's basically going for roughly 483, 490, somewhere in there. Credit if you were to enter it right now. But, also if you were to enter this, you're in the money too. Your call is at 510. So I thought we would look at a few other of these I've added in here. So this is just the 510, 520 call credit spread, so it does not have the put side on it. It's actually going to look very similar because the put spread in this iron condor is basically worth nothing right now, just because it's so far out of the money. So you can see it's basically the penny right here And then as the SPY climbs, since we're short a call credit spread, we can see the call credit spread is actually losing money. It's going against us. And once again, we have the volume and open interest right here. And this is a short strangle. So we're short both the 450 and the 510. Same expiration. So, if you were to enter this, this 450 and 510, back July last year, you could have got roughly $19 credit, and right now it's only worth about $8 or $9. So you would be up now, and we can see how the SPY's climbed. And once again, our open interest right here. This is the volume as well. And this is a put credit spread right here. So this should actually be pretty profitable if we look at it. So, if you entered this put credit spread, back when the SPY was, 440 to 450 range, you could have got roughly a $10 credit for it. And right now, it's only going for 17 cents. And it's basically just kind of stayed with the SPY and moved with it. Just because you're short to put credit spread. So it's going to make money as long as the SPY is going up. And that's basically what happened. And there's our open interest right there, and then our volume. And lastly, I thought I would show the bear put ladder. It's a pretty popular trade a lot of people use. It's mainly known as the 1-1-1, or it's basically 1 negative 1 negative 1. Is how a lot of people put this, like in YouTube videos. Basically, this just means you're long one contract and then short two contracts. And then sometimes it's the 1 negative 1 negative 2. That means you would be short basically 3 contracts, 2 of them at the same strike. But this is basically just a put debit spread and then a short put farther out of the money. So this would be like buying the 400 put, selling the 390 put, and then going farther out of the money and selling the 360 put. If this was going to be the 1-1-2, you would just have 2 360 puts. And that's basically what this looks like. So, if you open this trade back in, May of last year, 2023, you could have got roughly a $10 credit for it. And, it's basically gotten close to zero right now. Because of how this trade is put on, if you get within the profit range, which in this is going to be between 400 and 390, if you get between 400 and 390, you actually can get above zero here, so you can get into a debit range. So you could open this for credit and actually close it for another credit, which is something that can happen. But normally that happens closer to expiration on that style of trade. And then once again, we have your open interest right here, and then the volume. And then lastly, I thought I would show a trade that I actually entered today, mainly just to show a different time frame. So this was a 0 DTE type of trade. And this is an SPX, so I'm going to actually change studies. And the comparison line, I'm going to change it back to SPX. And because this was a 0 DTE trade, I'm actually just going to do a shorter time frame. We'll do a 3-day, 2-minute chart. And so in this trade, basically, I just sold a call spread. I tried to sell close to what was kind of the high of the day earlier today when I entered. So I entered like at 10:45, somewhere in that range. So I sold it for about 160, and then I got out of it around 11:15, and I got out around 120. So we can kind of see the price of the spread here has kind of decreased in value as the SPY dropped, because it was a call credit spread. And then once the SPY started rising, the call credit spread actually started increasing in value, which would be bad for you if you're holding a call credit spread. So anyway, hopefully this was helpful, and thanks for watching, and have a great day.